Are you properly filing taxes from your cryptocurrency investments? Do you know, believe it or not, the IRS does know what you owe, and a majority of investors are not filing correctly, or even at all. CoinTracker can help take the guesswork out of filing and make sure you're doing it right. Joe talks with Shehan, head of tax strategy at CoinTracker. Shehan is one of the handful of CPAs in the country who is recognized as an expert on cryptocurrency taxation. Joe asks Shehan about properly filing procedures and tracking throughout the year, and also how you can save on taxes using your self-directed IRA. Remember to hire a good CPA familiar with cryptocurrency and to always be consistent.
Hello, Shehan. Welcome to the show. Let's get rolling by giving us a brief background about yourself.
Hey, yeah, thanks for having me, Joe. So my name is Shehan. My background is a CPA. I'm the head of tax strategy at a company called CoinTracker, which is pretty much the TurboTax for crypto tax payers. That's what I do.
So and how long have you been in the tax business?
Getting close to 10 years now, ever since, I got out of school and started as an intern, made all the way from intern to a partner. And now I'm with CoinTracker and, I do a bunch of other things in the tax field. It's funny to say that in the past 10 years, I've only been focused on taxes because this is something that a lot of people only care about around April 15th. But for the past 10 years, that's all I've been doing.
No, I agree, but everyone needs to be looking at it, on a daily basis, obviously, because all the transactions throughout the whole year will affect their tax bill at the end, right?
That's right. Yeah. So you had to worry about taxes while you're inside the year, not when you file for taxes. Because when you file for taxes, it's barely you cannot do anything to make an impact on your tax bill for the prior year. So you got to make actions. You got to do things while you're inside that tax year, which is right now.
So tell us a little bit about CoinTracker and what it does.
Yeah, so CoinTracker is a tool where you can connect your wallets and exchanges into one platform, and it just gives you the tax forms that you need to file with the IRS. Because if you guys are using crypto exchanges, the problem with them is that they're not giving you the right information. They're giving different types of tax forms. Eventually, you need a tool like ours to kind of consolidate all those tax forms and information into one system, and produce the right tax form. So that's what CoinTracker does.
Now, do you concentrate only on US people, or are you guys globally, or what jurisdictions?
Yeah, we are based out of US. We mainly support US taxpayers, but we also have support in Canada, Australia, and UK taxes as well.
How do you manage all the different tax laws?
I mean, it's a technology product, so it's pretty easy to scale. I mean, there are some minor differences between how you create cryptocurrency, across various countries. But generally speaking, the countries that I mentioned seconds ago, Australia, UK, and Canada, those countries, tax cryptocurrencies as a property. So the fundamentals are the same, but there are some, minor, edge cases. So in those cases, we just had to kind of figure out those edge cases and kind of code that into the technology product that we are building.
For everybody who is getting started in the crypto space, how important is it that they're tied to some kind of tax software?
Without a tax software, it's virtually impossible for you to kind of calculate your cryptocurrency gains and losses, especially if you're using multiple wallets and multiple exchanges. The reason being, because the IRS is treating cryptocurrencies as property, you need to keep good track of, how much you paid for the cryptocurrency and how much you are selling it for, and then the date you purchase. And imagine you have, I don't know, 10, 15 cryptocurrencies, spread across multiple exchanges. I mean, how are you going to gather all the data? And even if you can gather those data, is it worth spending your own time where you can, spend that time, doing something fun, So that's why you really need a crypto tax software to kind of aggregate all that information and, and then apply the latest tax rules, because, these rules, they change, without even you knowing it. So if you're relying on a tool, we aggregate that information, give you all the right tax form, then it's just a matter of you filing your return and staying out of the IRS trouble.
Now, do most platforms or exchanges, I guess, have API access and that allows that data to dump back into your software?
Yeah, that's right. So there are a lot of exchanges that it's just a matter of you copying and pasting the read-only API. So we don't have the ability to move or transfer any funds. We only have the ability to see the balance, because we need to see that to produce the right tax form. So yeah, there's hundreds of exchanges that we have connected to APIs, but there are other exchanges that don't have this API support because it could be some restrictions from the exchange side. In that case, you can go to the exchange, download the CSV file, upload it. It's a little bit of a manual process, but it's still better than running all those numbers on an Excel spreadsheet.
No, I agree. And in my experience over the last few years, it's something that is really good for investors to set up in the beginning. Because if you get months or 6 months down the road at the end of the year and you set up all these wallets and everything across multiple exchanges, you just have a big mess, right?
Yeah, we get those cases all the time, and a lot of OGs, like they didn't even know about these crypto tax laws, and because people started kind of discussing these taxes like around 2018, 2019, they're like, oh, I didn't know I had to pay taxes. So some of them, they had to kind of recreate that entire history, and then some of those exchanges, they don't even exist anymore. So then it's just a matter of like, how do I even find out how much I paid for this? Like if you had to go through Mt. Gox, like how are you going to get the transaction history report? That exchange doesn't exist. So yeah, like you said, Joe, like I think it's best practice is to kind of get things started right, so then you don't have to suffer in the future.
How does it work, I guess, in regards to how does it aggregate all the data? How does it pull in from all the wallets?
Yeah, so once you connect CoinTracker to, let's say, for example, Coinbase or Binance or Kraken, from the APIs, we pull the data from the exchanges, your transaction history, purchases, sales, and transfers, and etc. And then we convert those amounts into US dollars because your tax return is based on US dollars. And that's where, we add value because each of those, if it could be like an airdrop or staking, like every little bit of those cryptocurrency should be converted into USD. Each at the time that you receive it based on each second. So and it's not as easy as you're multiplying the number of units received by the price that you see on CoinMarketCap, because there are some pairs that you cannot find a price, and some prices are not super accurate. So we kind of go to that cleaning, the cleansing the data, and converting into USD, and then transferring that information into the right tax forms, because there's a bunch of tax forms that you need to use, and doesn't mean that all your crypto profits are all lumped together in just one tax form. So and we prepare the tax forms, and then you file the return. So those are the things that have been taken care of by CoinTracker if you use that.
And do you guys have different types of plans from like do it yourself to all done for you, or what is it that you offer?
Yeah, so I mean, yeah, we do have a free plan. Again, CoinTracker, we don't actually file your return because that's a job that's being done by companies like TurboTax and China Block. But we do have direct integrations with them. What we're really good at is kind of reconciling your cryptocurrency gains and losses, making sure you're preparing the right tax form specifically related to crypto. And yeah, so we are responsible for the crypto piece, and then you can use one of these other software that I mentioned to actually file your taxes along with your W-2 income, business income, and etc.
So I know you mentioned something about like kind of the OGs and maybe people in the past or years ago didn't participate in the tax or understand that it was going to be taxable. And that's probably one of the questions people ask is how does the IRS know, right? And can you kind of explain the different ways?
Yeah, good question. I actually wrote a post about it because this is a question that people are kind of afraid to ask, like in public. But anyway, here's the answer for that. There are a few ways that the IRS knows you have something to do with crypto. So number one, so if you ever receive like a tax form from an exchange, it could be a form 1099K, 1099 miscellaneous, 1099 interest, any type of tax form, that means IRS knows that information because that exchange has already reported your information to the IRS by the time they produce that form. So what I would encourage you to do is go to your exchanges, especially the US ones, go to their tax center or like settings or something and see if you have any tax forms. If you do, that means IRS already knows your information, and if you don't report that information, then you're going to get a notice. And I'm not saying you're going to get into trouble like tomorrow, but they're going to send you a notice saying, okay, you didn't report it. Because of that, we are going to assess this much of taxes. So that's number one. Number two is by just if you look at your Form 1040, especially starting 2020, they have this question on the page one, and you had to provide the right answer to that question. They ask, have you received, sent, sold, or exchanged or acquired any financial interest? So when you say yes, I'm pretty sure that your data is going to get lumped into some type of database, and they're going to do some matching. and then they know you have something to do with crypto. So that's number two. And then another way is through subpoenas. Like, a few years ago, Coinbase gets subpoenaed. And as a result, they had to release their custom information, including social security number, names and addresses, and etc. So in that case, the IRS could get hold of your information through an exchange. So that's another way. And then lastly, there are a bunch of blockchain analytics tools like chain analysis and cipher trades. So those guys they have technology to kind of trace these random addresses and wallets into physical people. So if you're not reporting it, and if it's big enough, there's technology for IRS to know that this wallet or address is associated with this person. So those are the four ways that IRS knows you have something to do with crypto.
So do you think the IRS checkbox is more of a way for them to cross-check data that they might be getting or forcing from the exchanges and to make sure that people are complying or not lying on their return?
Yeah, it's a good question. It is a possibility. Again, they're trying to figure out, because right now the IRS doesn't know the number of Americans with cryptocurrencies. Because if you looked at the Coinbase as one, they're saying they have 43 million users. It could be worldwide, but say that they have 10 million crypto users in the US, and there's a bunch of other crypto exchanges as well. Say that number of crypto users in the US is like 20 million, which is very reasonable. But the problem is the number of returns that the IRS get with crypto transactions are in the low thousands. So there's a huge delta, and then IRS is like, okay, what's happening here? So I think their very first step is to kind of get a good, like a high level understanding of, okay, these are the number of people in the US with some type of crypto affiliation. Doesn't mean that they're going to have to pay any taxes, because you could just be hodling, right? And you don't have to pay any taxes, but they would like to know by adding that question and kind of gathering the answer to that question. There's a number of people, in the US with crypto. Say, for example, they find out, okay, there's 50 million people who say yes just for that question, and they only get like 1,000 returns. That's a huge problem. So I think that's what they're trying to do.
So I think you mentioned, but how are they classifying crypto for tax purposes?
Yeah, so for tax purposes, cryptocurrencies are classified as a property. Uh, it's pretty similar to stocks and securities. You have a purchase price, which we call cost basis, and you have sales price, which is, sales price is sales price, pretty self-explanatory. And if there's a difference, you pay taxes, which is typically capital gain taxes. So I think the easy way to remember is that when you trade crypto, it's very, very similar to, trading, stocks like Apple or Tesla.
Okay. And so what are the different, I guess, buckets of income that are allowed within the crypto space? And I guess, is it short term, long term?
Mm-hmm.
Is there ever ordinary?
Yeah. So if you're selling your crypto after holding it for less than 12 months, which we call short term, so that's called short term gains, and short term gains are taxed based on your tax bracket. So the tax rate could go from 10% to 37% depending on your income. Now, if you're selling your crypto after holding it for more than 12 months, we call it long term gains. And then the long-term gains are taxed at either 0%, 15%, or 20%. So the long-term rates are good. So if you really have to sell something, make sure you sell at least after holding it for more than 12 months. So those are the capital gain side of things. But in the crypto space, there could be some situations where you're going to get taxed at your ordinary income rate. So those are the situations where you get airdropped, or you get paid in cryptocurrency for performing some services to a company, or you go to a hard fork, or you are earning DeFi interest income or anything similar. Those are situations where you had to pay ordinary income taxes as opposed to capital gain taxes.
Now, on the short-term capital gain and or long-term, can the investment surtax 3.8% or whatever apply to that also?
So the 3.8 net investment income tax, yes, it does apply if you exceed certain income threshold. I don't remember the thresholds on the top of my head, but if you're married filing jointly, if you make over $300,000 or more, then in addition to that, for example, let's say long-term capital gain 20%, you also have to pay a 3.8% extra net investment income tax as well. But it's not applicable for everybody. It's for people who make above a certain threshold.
So, I mean, it can be very important to manage your trades in a sense to get into that long-term tax bracket versus the short-term?
Yeah, I think that's one of the easiest things that anybody could do to reduce your taxes nearly by 50%. Because if you look at the highest order income tax rate, which is the short-term capital gain tax rate, is 37%, and then the highest long-term capital gain tax rate is 20%. So just by waiting 12 months or more, you're essentially cutting down your tax rate by 50%, and it's waiting. I mean, it could be a relative thing. I think for me, I think the waiting is relatively easy to do. It doesn't require any action from you. Obviously, you might be, the timing might be bad. Sometimes you could be losing for waiting, but just by waiting 12 months or more, you could be saving, so much money on taxes.
All right. Well, I want to kind of go through some of the different transactions that I guess people are doing these days and maybe how it'll be affected tax-wise.
Okay.
So I think selling the crypto to fiat is a pretty obvious one, right?
Yeah, that's the most obvious one. Just to give an example, say you got a Bitcoin for $1,000, you're selling it for 50,000. You got to pay taxes on the difference, which is 49,000. Yeah.
Got it. And now the one that maybe people didn't recognize early on is going from one token to another token.
Yeah, this is something that I guess it's somewhat counterintuitive to people unless they're working in taxes like me, because they're like, okay, I didn't cash out anything, so why do I have to pay any taxes? But unfortunately, that's how it is, because IRS taxes you if you have access to some type of wealth or gain, and that wealth or gain doesn't necessarily have to be in cash. So let's take an example. Say that so let's go with the same example that I mentioned earlier. You have a Bitcoin for $1,000, which you purchased like so many years ago. Now it's worth 50,000, and instead of cashing it out, what you're doing is you're converting that Bitcoin into a bunch of Ethereum. So in this case, you're getting $50,000 worth of Ethereum, meaning you have access to some type of wealth, even though you haven't realized any cash. So that's the reason why when you go from Bitcoin to Ethereum or any crypto to crypto, you had to pay capital gain taxes on the difference between the cost basis of that first coin and the sales price or the disposition price of that the first coin to obtain the new token. So you don't necessarily have to have cash in your pocket, but if the coin has appreciated at the time you spent it to get another token, you got to pay taxes.
I know there was some talk for a little while, a couple of years ago, I believe, about the in-kind exchange. Can you kind of give us some details on that?
Yeah, there were some arguments saying that, okay, these are in-kind exchanges because before 2018, there was this tax code section called like-kind exchange, section 1031. The idea was that if you're exchanging one property to another, instead of paying taxes right now, you can kind of roll over your taxes into the second property, and then you can kind of keep rolling over things. So some tax practitioners thought this was appropriate for crypto, and they kind of did that when one person went from one coin to another. So they never pay the taxes because they were rolling the tax bill into the second coin, to the third coin, and fourth coin, etc. But this is not applicable, unfortunately. In 2019, IRS came in and said, crypto to crypto trades are taxable. And even if you go right now to the IRS website FAQs, just type virtual currency FAQs, you can see that they're specifically saying that if you're trading one cryptocurrency to another, that's a taxable transaction. So that like-kind exchange or in-kind exchange treatment is not applicable for crypto.
Now, I know from experience, sometimes when you have multiple wallets, you might occasionally get these, orphan like tokens that get dropped into your wallet, I guess, otherwise known as airdrops. Can you explain that?
Yeah, so the airdrop is the other situation where that people find it kind of counterintuitive because they're like, okay, I didn't this is something that I got like free of charge. I didn't even ask for it, and right after I got it, the price went down, and why do I have to pay taxes on this? Again, unfortunately, the IRS, if you read Notice 2019-24, it's actually a revenue ruling. It's not a notice. So that revenue ruling was published to specifically address these airdrops. Unfortunately, the ruling is that if you're receiving an airdrop, let's say it's worth $10, you got to pay taxes on that $10. It doesn't matter if that $10 coin goes down to $2 or goes up to $20 on the next day. You got to pay order income taxes at the time you receive it. So, and then airdrops, I think, especially this year, it's important because last year we saw Uni airdrop, which was significant. There's Spark airdrops because I know XRP is a huge community, so those people are getting XRP, the Spark token. Unfortunately, again, At the time you receive it, that creates a taxable event and you got to pay taxes.
I've seen where maybe some airdrops come into a wallet and the software doesn't pick up on a price because it's an unknown token that maybe hasn't traded in the marketplace long enough. How is that treated for price wise on the day received?
Yeah, it's a good question. So Iris is saying that you have a taxable event in an airdrop when you get a coin and when you have dominion and control over it. In simple terms, what it means is you have the coin and you have the ability to transfer and move the coins. That means you're in control of that coin. And if you can prove or if you can document that, okay, at the time I gained control for this coin is not worth anything, then you don't have to recognize an income. But then it comes down to the fact that you kind of keeping documentation to prove that this coin at the time I gained control over it, this is zero. There's no established market. So that's how I would go about it.
Okay. And so now a lot of people, obviously, they might have Bitcoin and they want to move over to the Ethereum ecosystem. So they want to move over and wrap the Bitcoin to participate there. Is that a transaction? What happens there?
I feel like you're asking all the right questions, and these are the most frequently asked questions, specifically in the past few months, especially on Twitter. Yeah, again, so just to kind of give a background for people. So say that you have Bitcoin and you want to kind of play with Ethereum, lending and etc. Unfortunately, you cannot do it with Bitcoin because Bitcoin doesn't have that ERC20 standard. So the workaround is that you convert Bitcoin into WBTC or wrapped Ethereum. So with wrapped Ethereum, you can do whatever you want with in the Ethereum ecosystem. Now the question is it considered a crypto to crypto trade because you're putting your Bitcoin into some type of platform and you're receiving wrapped Bitcoin, which is a separate coin, and you can trade wrapped Bitcoin, in other exchanges, etc. Again, Iris hasn't said anything directly about it. I guess there's two positions that you can take. The conservative position is that you're converting Bitcoin into wrapped Bitcoin, which is a different coin, in the eyes of the IRS. So that's considered a crypto to crypto trade, which sucks for the taxpayer because you got to pay taxes for no reason because you didn't want to sell it, but you still had to pay taxes. Again, that's the most conservative position. And then the second, somewhat aggressive thing you can do is that, kind of document your workflow and the process saying that, okay, I did convert my Bitcoin into wrapped Bitcoin, but my intention was not to sell. My intention was to add additional functionality to the Bitcoin, so I can, work in the, ERC20 environment. So in that case, that would not be considered a taxable event because it's just the same Bitcoin. You didn't want to sell. So those are the two portions that I usually tell like anybody. And then I've seen, some clients, taking the most conservative portion because they don't want to get into any type of trouble. And some people are like, let's just take the aggressive approach because that's what makes the most sense. If the IRS comes after them, then they will, deal with it at that time.
So I know that, over obviously the last year with the automated market makers, that there's a lot of need for liquidity on these decentralized exchanges. So can you discuss what happens when, people are providing those liquidity pairs on the DEXs and the rewards?
Yeah, again, everybody is doing these, liquidity providing and, those rewards in a different way. Uniswap is doing in a different way than, other platforms. So I think, again, without knowing the specific, without talking about the specific exchange, it's really hard to kind of generalize. But just to kind of give you, I guess, a high level idea, like whenever you earn something, like in almost all the cases, when you provide liquidity, you're getting some type of reward. So that's taxable, as order income because that's this new income. I would say, again, it's so in the case of Uniswap, I'll just give an example. In the case of Uniswap, like you have two pairs, you had to put the same ratio, and as soon as those ratio is inside a liquidity pool, that ratio changes like every second. So in that case, you had to. That's why I said you need to look into that specific liquidity provider and the liquidity pool to see how it functions. In the case of Uniswap, what makes the most sense is to take a P&L type of approach, meaning you have an entry price for the pool and then the exit price, and the difference, if it's a positive, then you would recognize it as income. versus tracking all those microtransactions happening inside the pool. Yes, again, and lastly, there's no set guidance on this because it's pools and providing liquidity, and especially in the case of things like Uniswap, IRS and other regulators have never seen these type of things. So right now we are in the stage where that we just kind of had to come up with our own tax rules based on reasonable assumptions.
And so when, so how do you see the difference in, like, let's say BlockFi interest that's paid out monthly versus these rewards that you get?
There's not much difference. I think in the case of Uniswap, it's different because that there's a ratio thing going on. In the BlockFi case, it's not. You just putting your money and then you're just getting an interest. And in the case of BlockFi, they make it even easier. You have an option to get paid in US dollars, which is like very, very straightforward. You just have to plug that number in the return. But I'm pretty sure a lot of people are not doing that. They opt in to get paid their interest in Bitcoin, so you have more upside. So in that case, it's pretty much similar. Anytime if you're getting a reward, it could be in terms of interest or any type of other reward, that's going to get taxed as an ordinary income at the time you receive it.
All right. So basically, whenever you're providing liquidity, the rewards you're looking at ordinary type income.
Yeah, for the most part, yes.
And so when you're providing a token and you're staking it for rewards, how do you see that?
Yeah. So again, staking, IRS hasn't said anything about staking. Going with the basics, tax principles and laws we know, every time those staking rewards hit your wallet, that's considered ordinary income. And yeah, just similar to mining income.
And why do you think that everyone views it that way versus, like, I don't know, interest income, or how do you guys arrive at that?
Yeah, I mean, so in the case of staking, again, it looks like interest income, but if you look at the IRS code, in order for something to be tagged as interest income, it has to be derived from forbearance of money to some type of institution, and there's no money involved here because you're staking a property. So that's why technically IRS doesn't call it interest income.
Okay. And I guess is there anything else that we didn't cover when it comes specifically to tokens?
No, I think we covered. I think there's a lot of these edge cases. I think if you don't want to get into trouble, I think this is what I say all the time. Like, when in doubt, just assume it's taxable. But again, make sure you hire like a good CPA. So that CPA knows, like, that CPA should know the tax laws and also the technology side of things. So he can use his judgment to kind of tell you, okay, there's no tax guidance on this specific case, but based on the information that we have, this is what we're going to do. And then you got to stick to that and be consistent, and then you should be good to go until we get further clarity.
And for a common theme, pretty much in the U.S. as a U.S. resident, is it pretty safe to say that if you buy anything in this world and sell it, basically, typically it's a taxable event, right?
If you buy crypto using USD, that's not a taxable event.
So, I mean, the sell of something that you bought at a greater price is a taxable event, whether that's a token or a bag of whatever, right? I mean, typically in the U.S., if you make any profit, it's supposed to be reportable.
That is right. Again, there are some exceptions.
Yep.
Like, for example, if you sell your primary residence, like up to a certain amount is excludable from taxes. But yeah, generally you're right. If you sell something at a profit, that's a taxable event.
It was just interesting because when everyone was kind of like, "Oh, we didn't know it'd be taxable," I'm like, "Listen, if you thought you were going to make any money as a U.S. resident, you should know something's going to be taxable." Yeah. But moving on, lately on Twitter, everywhere, everyone's hot on NFTs, right?
Yep.
There's the artists that are minting them, there's the buyers, and then there's the resellers. Can you kind of go through those different steps and how they're being taxed?
Yeah. I mean, so NFTs, non-fungible tokens, I mean, the principles are the same. Like we just discussed, if you're making a profit, like, if you're a reseller, you paid an NFT $1,000 and you're selling it for $20,000, you got to pay taxes on $19,000. That's capital gain because you're a seller. But if you're a creator and if you're in the business of creating stuff, so you can sell your NFT, let's say like a picture for like $20,000. So I don't know, like half a Bitcoin or something like that. So that's considered ordinary income for you because you're in the business of creating stuff. So those are the two distinctions that we need to know. Like if you're a creator, that's a different tax treatment, and if you're a seller, that's a different tax.
So with all the millions of dollars that are kind of, being transacted right now, do you believe the IRS is going to spend a lot more time to keep an eye on this on chain with certain companies?
Yeah, the IRS, I believe they have an agreement with Chain Analysis, and Chain Analysis have helped them, numerous times when it comes to dissecting these, criminal activity, happening in the blockchain, especially in the darknet and etc. So yeah, they have an ongoing relationship with the Chain Analysis. And then last year, IRS published this, job opening. It's like for these contractors. So they were soliciting private companies to come and de-anonymize Monero and Zcash transactions. So I don't know what happened. I'm pretty sure there's technology to kind of dissect those blockchains, which I consider to be privacy concern, privacy focused. Yeah, IRS is definitely especially in the criminal investigation side of things, they're working with these technology companies to uncover these criminal activities.
And that was kind of put out there in a bounty like offer, right?
Yeah, that was a bounty for it was a big amount. I don't remember
600,
that.
650, something in that realm?
Something like that. Yeah.
650,000, something like
Yeah.
that. Do you think that, also, I think because on their whistleblower thing, they typically have some kind of payout. Do you think a bounty of this type is going to start happening more often where maybe they're limited by the internal resources? So they start putting out rewards for external people. And that's a way for, I guess people to earn a living, right?
Yeah, I think there are some people, who, I mean, their main source of income is whistleblowing. Like then this could be for the IRS and could be the SEC or other regulators. In the case of IRS, again, I could be wrong. IRS is not an agency that rely massively on whistleblowing. SEC is for sure. And even if they're providing like a bounty or something like that, that's most likely that's going to be for criminal cases, not for civil cases where somebody forgot to report 100,000 and that's not the case. But for criminal investigation cases, I'm pretty sure they have those programs established.
So on the tax matter, when determining how you're going to utilize the transactions, whether it's first in, last out, or optimization, can you kind of describe that?
Yeah. So the accounting method that you use to calculate your gains and loss, has the biggest impact on your tax bill because the accounting method tells the IRS which specific unit that you're selling. And that has a big burden because, as you guys remember, your gains equals your sales price minus the cost basis. Now, there are several accounting methods that you can use. For example, you can use FIFO, first in, first out. So in that case, you're always selling the unit which you acquired the early. And it could be, higher price or lower price, doesn't matter, you just go by the date. And in some cases, that could be useful. Or you could use LIFO, that's called, last in, first out. That means you're always selling the unit which you, purchased, the most frequently purchased unit. What I usually see like a lot of people are doing, and this is the most tax advantageous accounting method, it's called HIFO, highest in, first out. So there what you do is you're essentially selling the unit which you paid the highest amount for, and thereby you're minimizing your gains. And in order for you to use HIFO, you need to have detailed records of each transaction, unique identifiers, dates, and etc. So that's where like a crypto tax tool come in handy. Like for example, in CoinTracker, it's just a matter of clicking a button. When you click HIFO, it just calculates all your taxable income and tax forms using HIFO. So yeah, HIFO is generally good for, I would say, 99% of the taxpayers. It produces the least amount of gains. But again, there could be edge cases where either FIFO, LIFO, some other variations could be more useful.
So once you have done a report for a year, does the system actually mark that transaction as being used for that year? And then can you choose a different one the following year?
Yeah. So IRS is saying that you could, there's two, according to the IRS, there's two methods. There's specific identification, meaning like, you can pick and choose whatever you're selling. If you have all the information, if not, you default to FIFO. So, HIFO, highest in, first out, is actually a subset of specific identification because you're nitpicking the unit which had the highest cost basis. Now, the question is, can you jump from, HIFO to FIFO and etc.? If you think about this logically, again, this is a logical reasoning. IRS hasn't said this, directly. if you have all the information to prove that you can maintain specific identification with it, meaning you have all the records, what that means is you could go from specific ID to FIFO to LIFO, etc. Because at that point you're essentially picking and choosing each unit that you're selling, and you can legally do that because you have all the information retained in your records. So to answer your question, yes, you can jump from one method to another, logically speaking, if you can meet the criteria for specific identification.
Now, if you have a big gain with some, losses and you're towards the end of the year and you kind of want to participate, can you, basically take your losses and rebuy back in?
Yeah. So this is one good thing about crypto is that because they're treated as property, they're not subject to wash sale rules. Like for example, let's say you got a stock and you're selling it at a loss and you're buying it back on the next day. IRS will not allow you to take that loss as a loss on your taxes because they're like, okay, you just sold this stock to create a loss because you just got back into the same stock within like a couple of days. So this is called the wash sale rule, and that window is actually 30 days. So you actually had to wait more than 30 days to get back into the stock and claim the loss from the first transaction. But for luckily, cryptocurrencies are not subject to this rule because these are treated as property as opposed to stocks and securities. So what you can do is, every quarter, every month, you can see where your portfolio is. If your portfolio is in the red, meaning your cost base is higher than the market value, you could essentially sell those losing positions and harvest the loss and quickly get back into the same position to maintain the upside. So that way you're kind of getting a tax relief for that, for that, because your cost base is higher than the market value.
Now, one thing that I've seen that some people don't discuss about or maybe think about as much when just, participating in that is that it resets the time period for the long-term capital gains, right? And some people don't think about that when they go to do it, because if it's end of the year and then you think this following year might be the cycle in which you take your profits, that could interrupt with your tax bracket, correct?
Yeah, it does. So whenever you sell something, that ends a capital gains clock for that lot, and then when you buy it, you start a new capital gains clock. So this is why, like, if you're really serious about tax planning, you gotta sit down with the CPA, and every quarter, like, you had to figure out, okay, should I tax loss harvest it? If I harvest this much of losses, what kind of impact that would make in my overall tax bill? Is it even worth doing that type of thing? And that's not something you can figure out just by looking at your portfolio, because your final tax bill is based on so many factors: your W-2 income, your business income, credits, the number of dependents you have, and etc. That's why you need to sit down with a CPA who understand everything, not only your crypto fees, but everything, and just come up with a plan. Okay, if I'm harvesting losses, how much losses should I harvest, and is there a net positive benefit for you by harvesting that losses?
All right. So I guess we're on to tax strategies and how one could participate in a tax-friendly environment. And that kind of brings me to the IRA structure. So what are the possibilities there?
Yeah, so IRA is one strategy. I think I see a lot of people doing these days. So these are called self-directed IRAs. So essentially, if you Google for self-directed IRA for crypto, you'll see a bunch of companies. So essentially, you trade your crypto inside one of these custodial accounts, and your gains are tax sheltered until your retirement age, which is like 78 and a half years old. And there's some a lot of complexities and etc. But some of these platforms make things really easy, and this is a great way for you to kind of get upside and kind of do your trading, realize any capital gains, but you don't have to necessarily pay taxes today. You just pay taxes at the time you retire, and in some cases you don't even pay taxes at the time you get money out of the retirement, because you're trading your Roth money, meaning you already paid taxes on that money. So again, this is another complex subject, but just know that make sure you go with one of these reputable companies, and they will guide you through these ideas.
I know out there's I guess the companies that will allow you to, I guess we call it self-direct through their exchange, we'll say, and then there's those that advertise for your own LLC where you're kind of managing it within the wallets, correct?
Yeah, I think those. So there's self-directed IRAs and there's checkbook IRA. There's concepts are somewhat similar. Again, this is another like area that IRS has not been very clear about, like certain edge cases. Again, that's why it's really important that you go with a reputed company so they can guide you through the process, because there's so many like rules and regulations that you need to abide by to get to make those profits tax free.
Yeah.
And you have to, like, you cannot like avoid you're kind of skipping those things. So you just have to make sure that your platform provider is completely aware about these rules, because at the end of the day, what's the point of, you're doing all these trades, but when you get it out, like it's taxable, then you would have rather done it, without paying these fees through a self-directed IRA. So make sure you find like a reputable provider.
So I guess one situation when you're investing with your IRA that you could run into is that if you have wallets that end up getting airdrops and or some kind of staking you're involved in, then technically, if that's generating ordinary income, could that be subject to also filing a 990T, and how to kind of track that if it
Yeah.
gets an airdrop in the IRA account?
So this is why, like, you need to use like a good custodian. Usually
Yep.
there's IRA itself has a tax filing obligation, which is not a Form 1040, it's another form. And if you're using a custodian, you're paying like a fee, and that fee takes care of your tax filings and then and everything. So because if you don't file a tax return for the IRA, that's not good, because that means you're exposing yourself for much more risk. But again, those tax returns and those transaction classifications are done by the custodian, and they're doing most of the work for you, and for you it's just a matter of funding.
So, like, to sum that up, pick a great software and pick a good custodian, right? On that side.
Pick a custodian, because if you're using a custodian, like they are integrated with software, because they need to figure out like what to report to the IRS through their return. So you don't necessarily have to do anything, because whatever you trade inside the IRA, like that doesn't go in your personal tax return. So you're completely fine. So something to keep in mind.
Now, beyond the, we'll call it the tax harvesting or the IRAs, or any other strategies that investors can participate in?
Yeah, I mean, I think the easiest thing is just hodling, right?
That's good.
Yeah, you have nothing to do, just hold, completely tax free. And actually, holding for Bitcoin, if you really think about it, it's extremely like completely tax free, because if you think about it, if you're holding like a piece of land, you got to pay real estate taxes and so many other things, right? If you're holding like a house or rental property, you got to pay repairs and etc. But if you're just holding Bitcoin, like it's completely tax free. All you had to do is just make sure you secure it correctly on a hardware wallet, and yeah, just keep. So that's the easy one. I would say the second easiest one, if you really had to sell, just sell it after keeping them for more than 12 months. So that way it's long term. You're getting better tax rates. I would say the third thing would be kind of playing with those accounting methods, and pick the one that fits your needs. And typically, high for highest in first out reduces your tax bill. So that's one. I mean, number four could be, I mean, again, it depends on your personal situation. You could consider moving to a state with no income taxes. There's a bunch of states like Texas, Florida. There are two examples. So that way you're essentially cutting that state income taxes, which could range from 6% to 13%, something like that. Yeah, I think those are I would say those are some of the very like main tax saving strategies when it comes to crypto.
And what do you think about taking a loan out against your crypto? Do you think that's going to become more popular as everyone gets more comfortable with the players in the market?
Yeah, so here's the problem about taking a loan. Again, if you really think about the cycle, right? Taking a loan against your appreciated crypto is tax free, and you can get a loan, you can spend it on Tesla or whatever you want. But the problem is you have to pay back the loan. So the question is, how are you going to get money to pay back the loan? Because if you send your loan proceeds in groceries and Starbucks and etc., and if you don't pay back the loan, they're gonna liquidate your collateral, creating a taxable event for you. So that's the thing. So getting a loan is good. The only time it's good is that you have a better way of investing that loan proceeds and make a higher return. So that way you can pay off the loan and have something else going as well. Otherwise,
All right.
it's not worth it.
I think that's about it. I mean, we have a final question we always leave off with, and that is, what is the biggest thing that you have implemented in your life that has increased your net worth?
I would say just investing in things that I cannot measure in numbers.
Okay, any example there?
I mean, I think there's a lot of examples. Some career decisions that I made, some risk I've taken. Like, me being a CPA, I always try to kind of quantify things, pros and cons. But the biggest returns in my life have come from things that I couldn't measure. Yeah, it could be like judgment and stuff like that, and kind of figuring out the narrative, or if it's like an investment and stuff like that. Because for example, I mean, you said you invest in early stage startups. I mean, there's no financial. You just invest on the narrative and the team. So yeah, so invest in things that this is what I spoke. I mean, investing on things that I couldn't quantify.
That's good. That's good. I mean, that's typically, where people are making a lot of money these days, right?
Yep. Judgment. Yeah.
So if people want to get a hold of you or they want to sign up for the CoinTracker software, what is the best way for them to go?
Yeah, I'm pretty active on Twitter, so it's pretty easy handle to remember at the Crypto CPA. And feel free to sign up for CoinTracker. It's cointracker.io. Yeah, there's a free tier and there's a bunch of other things. And if you have any questions, I think Twitter would be the best way to reach out.
Well, everyone who owns crypto I believe, should have tax software. It just makes life easier. So I, hope everyone reaches out to you to sign up.
Yeah, I mean, get something. I mean, you don't have to go with CoinTracker, just get something and just stay out of the IRS trouble.
Shehan, thank you for coming out today. I appreciate your time.
Okay, thank you.
Hey everyone, thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.